Cash flow and profit are among the most important metrics that are used to assess the financial performance of a business. Many people mistake these metrics to be the same, but they're not. In this video, we discuss the fundamentals of cash flow and profit, how they are different, and why profit does not necessarily equal cash flow. Meet Jordan. Jordan is a high school student who is interested in selling t-shirts to his friends, and the purpose of any business is to buy a good or service and sell it for a price that is greater than its cost, resulting in profits for the owner. This is exactly what Jordan aims to do as well. Let's go over some key concepts and how profits are calculated in a business. So the first concept we want to familiarize ourselves with is revenue. Revenue is the income generated from the sale of a good or service, and expenses are the costs incurred in order to make that sale possible. In Jordan's case, his revenue will be generated from selling t-shirts, and his expenses are the costs of purchasing those t-shirts. Profits are then the surplus that remains after all of a company's expenses have been deducted from its revenue. And so the formula to calculate profit is revenue minus expenses. Now this is a highly simplified example, but suppose Jordan buys 10 t-shirts for $500 and sells them to his friends for $800. In this case, the cost of the t-shirts is Jordan's expense, and the sale of the t-shirts to his friends is Jordan's revenue. Since revenue minus expenses equals profit, Jordan makes a profit of $300 on this transaction. Now it's important to note that when the difference between revenue and expenses is positive, then the business has made a profit, as we saw in the example earlier. However, if the difference between revenue and expenses is negative, whereby a company's expenses are greater than its revenue, then the business has made a loss because it was unable to sell its goods or services for a price that is greater than their cost. Now, what's really important to remember is that not all revenue of a business is immediately received in cash, and not all expenses are immediately paid in cash. This is a big reason why profit and cash flow are not the same. Cash flow simply refers to the actual cash flowing in and out of a business. A company needs cash flow to survive, since all of its expenses and financial obligations must eventually be paid in cash for the business to continue operating. Excess cash also enables a company to invest in initiatives that can help it to continue growing over the long term. So in order to calculate the cash flows of a business, we would look at the actual cash inflows and subtract the actual cash outflows to arrive at the net cash flow, or simply cash flow, for that company. So in Jordan's case, he might not pay his supplier the full amount for the t-shirts immediately in cash. He may decide to pay some of it in cash and promise to pay the rest in the future. So effectively, although Jordan has booked the entire $500 amount as an expense, he will not have paid the full amount in cash just yet. The same goes for revenue. Jordan's friends may not pay him for the t-shirts in cash immediately. Instead, they may decide to pay some cash right now and promise to pay the remaining amount in the future. So even though Jordan has booked the entire $800 amount as revenue, he will not have received the full amount in cash just yet. And this can create discrepancies between profits and cash flows. So consider this scenario. Jordan buys 10 t-shirts for $500, but promises to pay his supplier in 2 months. So although Jordan has received the t-shirts from his supplier and has recorded an expense of $500, he has not actually paid any cash to his supplier just yet. On the other hand, Jordan sells the t-shirts to his friends for $800, who immediately pay cash. So cash is actually collected on the sale of the t-shirts by Jordan. And so when we look at the actual cash that was received and paid by the company, we can observe that Jordan received $800 from the sale of the t-shirts to his friends, but there were actually no cash outflows of the business because no cash has been paid to the suppliers for the t-shirts just yet. And so because net cash flow is simply cash inflows minus cash outflows, in Jordan's case, he received $800 and made no cash payments, resulting in a net cash flow amount of $800, which is higher than the profit amount of $300 that we observed earlier. Now consider another scenario where Jordan buys the same 10 t-shirts for $500 and immediately pays the supplier in cash. So an actual cash payment has been made this time. Alternatively though, he sells them to his friends for $800 who promised to pay cash in 2 months. So in this scenario, a cash payment has been made, but no cash has been collected from the sale of the t-shirts to Jordan's friends. And so going back to the net cash flow or cash flow formula, we have no cash inflows coming into the business, but we have a cash outflow of $500, resulting in a net cash flow amount of negative $500, which is lower than the profit amount of $300. Now, you might be wondering, why does profit include revenue and expenses that have not yet been collected or paid in cash? Wouldn't it be simpler to record revenue when cash is received and record expenses when cash is paid? That is true. This would be simpler and refer to the cash accounting method. When a business uses cash accounting, it only records revenue when cash was received and records expenses when cash is paid. However, the financial statements of a company are prepared using the accrual accounting method, whereby revenues are recorded when a good or service has actually been delivered to a customer, regardless of whether actual cash is received or not. And expenses related to these revenues are recorded as well, regardless of whether actual cash is paid or not, in order to provide a more accurate picture of a company's financial performance. Additionally, revenue and expenses are not the only sources and uses of a company's cash. So far, we saw that Jordan purchased t-shirts, which were both an expense and cash outflow, and he sold the t-shirts to his friends, which was both revenue and cash inflow. However, there are many instances when cash can be received or paid by a business for items that do not necessarily fit the category of revenue or expenses, and thus have no impact on the profits of that company. Cash can also be received when capital is raised by a company from its owners and investors, whereas cash can also be paid to purchase assets that can help a company to grow, which can include equipment, vehicles, and patents, and payments can also be made to company owners and investors to provide a return on the capital that they have invested in the business to date. These items will not be reflected in profit because they do not fit the category of revenue or expenses. So which one is more important, profit or cash flow? It really depends on the context. For example, it is possible for a profitable company to fail because it didn't have sufficient cash flow, which prevented it from paying its expenses or continue growing. On the other hand, a company with strong cash flow may just have raised capital from external investors and may actually be incurring constant losses where its expenses exceed its income, which will ultimately cause the business to fail over time. Therefore, the importance of profit and cash flow really depends on the context of the business being analyzed. Furthermore, profit and cash are just two of the many indicators that are used to make informed decisions about the financial performance of a business. If you enjoyed this video, please like and subscribe to our channel. If you're interested in pursuing careers in finance, check out the link to our training program in the description below. Our program includes dedicated interview prep, mentorship by current industry professionals, and direct career placement opportunities in finance. Thanks for watching, and we will see you in the next video.